Investors, hello. This is Stock AI Insights, your chief AI analyst. Just a quick reminder, this is for educational reference only and not investment advice because investing always involves risk. Today, we're parsing a fascinating CNBC article about how the ultra-rich were playing their cards as markets hit record highs last quarter. In just about 6 minutes, you'll get the key pulse. So let's start with the big picture. Global markets, totally supercharged by AI enthusiasm, have been on an absolute tear.
So that brings us to the big question, right? When everything seems to be going straight up, the moves made by the most sophisticated players, we're talking the ultra-rich, family offices, become really, really telling. It's not just about what they're buying into, it's about what they're quietly selling off. So let's dig into their strategy.
Okay, first, let's really set the scene. The market is running hot. You could say it's at a fever pitch. Fueled by all the excitement around AI and tech, the indexes are just soaring. It's a full-blown bull market, and it kind of feels like the only move is to buy, buy, buy. And hey, to be clear, even the smartest money out there isn't just sitting on the sidelines.
Now, at first glance, everything seems to confirm what you'd expect. I mean, look at this. Soros Fund Management massively upping its stake in giants like Apple and Amazon. Stanley Druckenmiller's Duquesne family office is getting back into Amazon and Meta. And David Tepper's Appaloosa, they're adding even more Nvidia. So yeah, it looks like they're all just riding that tech wave. But, and this is a big but, that's only half the story. So let's move on and see the other side of this coin. Because while these huge family offices are for sure participating in the rally, they are also very, very quietly cashing in their chips. This is where real discipline comes into play.
Right. While all the headlines might be screaming about the big tech buys, if you look closer at the filings, you see a crucial second step to their game plan: systematically taking profits off the table. Now, this isn't them trying to time the market perfectly. Nope. This is about smart risk management. It's about rebalancing after a period of just incredible growth. They are selling into strength. And wow, this right here just perfectly illustrates the point. Check out this tale of two moves. Oracle stock goes on a tear, rallying almost 29% in just one quarter. So what does David Tepper's Appaloosa do? It sells its entire position, 100% gone. So while everyone else was chasing that momentum, Tepper was quietly heading for the exit, turning those paper gains into cold, hard cash. That is a profit-taking masterclass.
And this wasn't just a one-off thing with Oracle. Not at all. The strategy stretched across other tech titans. Appaloosa also completely got out of its Intel position and even trimmed back its Meta holdings. This shows a really clear pattern of lightening the load on names that have had huge run-ups, which, of course, frees up a ton of capital for whatever they're planning next.
So that leads to the obvious next question. If they're cashing in on these high-flying tech stocks, where is all that money going? And folks, this is the twist. This is the pivot in their strategy, where these investors decide to zig while pretty much the rest of the market is zagging. Exactly. All that capital unlocked from selling winners like Oracle and Intel, it has to be put to work somewhere. Is it going into cash? Into bonds? No. It's going somewhere way more interesting. And frankly, it's going to a place most investors are running away from right now.
2,000%. I mean, just let that number sink in. That is an absolutely massive increase. When a major fund like Appaloosa makes a move of this sheer size, you just have to stop and ask, what on earth could justify such a high conviction bet?
They poured that cash into the home appliance maker, Whirlpool. Yeah, Whirlpool. Take a look at this chart. While the S&P 500 is having a fantastic year, Whirlpool stock has just been hammered, down over 30%. This is the very definition of a contrarian move. You're buying a deeply unloved, beaten down stock in a sector that's really struggling. It's buying the dip in its most extreme form.
And you know what? Tepper isn't alone on this treasure hunt. This contrarian, value-seeking strategy is being rolled out by several of the world's most successful investors. They're all finding what they believe to be hidden value, where most people just see risk. This table lays it all out beautifully. You've got Carl Icahn upping his stake in international flavors and fragrances, another stock that's down big. Then there's Leon Cooperman's Omega Advisors, adding significantly to its Cigna position, a healthcare stock that's also had a tough year. Do you see the theme here? Consumer goods, healthcare, these are sectors that are totally out of favor, miles away from all the AI hype.
So, and this is the crucial point, this is not just some random bottom fishing. This is a deliberate, calculated strategy.
These investors are using their massive research teams to find companies that they believe are fundamentally undervalued by a pessimistic market, setting themselves up for a potential rebound down the line.
All right, so how do we tie all this together? Buying red-hot tech on one side and beaten down value stocks on the other. It seems totally contradictory, but it's actually part of a very sophisticated, well-known institutional strategy. Let's put all the pieces together.
It's called the Barbell Strategy. And yeah, it's pretty much what it sounds like. Think of a weightlifting barbell. You've got the heavy weights on both ends and nothing in the middle. In investing, it means you focus your portfolio on two extremes. On one end, you have your high-growth, high-momentum stocks, like Nvidia. And on the other end, you have these deep-value, contrarian plays that are out of favor right now, but have huge rebound potential, like Whirlpool. Let's break down exactly how it works. Step 1 is you secure your profits. You lock in those gains from your high-growth winners, just like Tepper did with Oracle. Step 2, you take that cash and you go on a value hunt, putting it to work in those deeply out-of-favor assets. The result? Step 3, a balanced portfolio. This allows you to play offense, capturing all that market growth, while also playing defense, setting yourself up for a different kind of market where value stocks might lead the charge.
So, our pulse verdict is this: sophisticated investors aren't just mindlessly chasing the rally. They're playing offense and defense at the exact same time. They're using a disciplined barbell strategy to ride the market's growth while strategically digging for treasure in undervalued assets for the next cycle. And that leaves us with a final thought-provoking question. If you were using this Billionaires playbook, what unloved stocks or sectors out there today do you think could be the hidden gems of tomorrow? We'd love to hear your thoughts in the comments. See you in the next episode.